Lonsec wishes to remind that the information we provide on our portfolios is general advice, and we encourage investors to read the PDS or seek professional advice prior to making any decisions on their investments.
Hi, I'm Martin Graf, Financial Leadership. We specialise in helping retirees look after themselves and their investments and get up to retirement. Today, we're very fortunate to be sitting down with an expert from Lonsec, Dan Maradi, who looks after the investment side of things, particularly the direct shares, investments in the portfolio. We're going to get some expert and answers from Dan and the team to kind of talk about some topics from today.
It's been a huge factor in the market since the GFC, and there was a reason. Is it's supportive of asset prices and risk assets when you have basically the cost of money has been artificially low for a long time, and the reason why all these things are happening in the market right now is the cost of capital is going up. But having said that, we're at zero. Even if we go up to 1.5% or 2%, as some are saying, that's a new neutral rate going forward. In absolute terms, compared to what we've seen in the past, it's not that bad. It's not that high, particularly given the large amount of debt that's in the system at the moment. It's more than before GFC. It's higher than pre-COVID. So there's a lot of debt in the system. So as a whole, I don't think we can afford the higher interest rates or the interest rates of the past. So the new normalized rate should be lower than the past. But look, there's tail risks in terms of runaway inflation, geopolitical issues. We don't know what's around the corner. A couple of years ago, we didn't have COVID, we didn't have the geopolitical issues that we're seeing in Russia and Ukraine, and that's caused a big dislocation in markets. So there could be further left field events that could extend this phase. So that's why it's a difficult time, a challenging time in the market because of those factors. It's almost like the bottom-up fundamentals have been put to the side, and these factors are taking over. But and the other thing about risk-free rates is basically, I think if you're consistent across your universe, you can't use different risk-free rates for different companies. So as long as you're consistent, then you should get a relatively similar answers in terms of evaluation. So if you're changing it for CSL, you got to change it for Afterpay, you got to change it for Xero, and you got to change it for Telstra. It's the same risk-free rate, so you'll get a good sort of view on terms of what gets impacted in what way. And usually, your lower growth businesses, when you adjust that risk-free rate, are more positively impacted because they have lower growth profile, and the longer duration growth stocks get penalised because of a lot of their earnings is in that terminal value.